Hello friends, a warm good morning to all of you. This is Dinesh Jain. In today's session, I am going to cover a topic called 10-point action plan for tax planning. Before we proceed ahead, let's try to understand what tax planning actually means. For most of us, tax planning means looking for an agent in the month of Jan, Feb or March of every year and put some money in instrument in haste to save tax. But let me tell you, on the basis of the interaction I had with hundreds of investors, if you do like that, then you will be in deep trouble, which you might not realize at the initial phase of your career, but at a later stage you will definitely repent. So now let's look what tax planning really means. The name itself suggests it's a planning exercise. I repeat, it's a planning exercise to minimize your tax liability. And how do we do that? We do that through optimal use of different allowances, deductions, exclusions, exemptions being available, about which I will talk in details little bit later. And the most important point is the second one, that is, while doing your tax planning, keep the big picture in mind. I mean to say, keep your financial goals in mind while doing your tax planning. You should choose the tax planning product in such a way that it not only helps you in minimizing your tax liability, but which also takes care of your long-term financial plan. So now see the different steps one by one. What I will do is I will take each point and simultaneously put them in the income tax calculator so that it becomes easier for you to understand. So what is the first point? The first point is list down all the components of your salary like basic HRA allowances. So I have one of the salary slip of one of my clients. So your salary structure might be different from this, but try to understand the logic over here. So I have listed down all the components of the salary, and if you see here, the total C2C of this person is 14,34,800. Now what is the second point? Now out of all these components, not all the components are taxable. So the second point is we should remove all those non-taxable components. So which are those? First one is HRA, second is EPF, and third is professional tax. So when I say remove HRA because it is non-taxable, it does not mean that you should remove the entire 1,80,000. So if you see here, I have written some basic calculation is required. So what is that basic calculation? So that basic calculation will be something like this. So this is the HRA exemption calculator. So first of all, you have to select which is the city you are living in. So either you will be in a metro or a non-metro. Now let's say you are staying in a non-metro city. First one is basic salary plus DA. So if you again see the salary structure, what is the basic salary? It's 3,60,000. So I have taken 3,60,000 under basic salary. Now what is the second point? Second one is HRA received. So what is the HRA you are getting? It's 1,80,000. So I put in 1,80,000 under HRA received. Third one is actual rent paid. So let's say you are paying a rent of 13,000. So it becomes 13,000 into 12. So your annual rent becomes 1,56,000. Now 13,000 I have just taken an example. So you actually need to take the amount which you are actually paying in the form of rent. Now list of the following will be HRA exempted. So which three figures are there? So first one is HRA received. So what is the HRA you are getting? 1,80,000. Second is percentage of salary. Now if it's metro we take 50%, if it's non-metro we take only 40%, because it is a non-metro. So what we do is we take only 40% of basic. So this is how I have arrived at 1,44,000. The third and the most important point is rent paid. So what is the rent you are paying? Rather, this person is paying 1,56,000 and 10% of basic. So what is the basic amount? Basic amount is 3,60,000. I will take 10% of basic. So what here it is saying is rent paid in excess of 10% of basic. So how much extra rent you are paying in excess of 10% of basic? So that's how it is coming to 1,20,000. So here I have taken 1,20,000. Now list of the following three will be tax exempted. So which is the list amount? It's 1,20,000. So what I do is I deduct 1,20,000. Okay. So this I have taken 1,20,000. So now what is the second non-taxable component? That is EPF, Employee Provident Fund. But here you need to remember, so when you get EPF from the company, so 50% is contributed from the employee and 50% is contributed by the employer. So only employee's contribution is exempted, that is 50% of your EPF is exempted. Now in the current example, if you see, so what is the total EPF? It's 86,400. So that is the annual EPF. So 50% of this will be 43,200. So what I do is I remove another 43,200. Now EPF comes under ATC, which I will cover little bit later. Okay. Then the third point is professional tax of rupees 2,400, that is also non-taxable. So what I do is under professional tax I remove 2,400. And the third point is deduct rupees 40,000 as standard deduction. Now from the financial year 2018-19 there will be a standard deduction of 40,000. So I put 40,000. So with this, what has happened, although the C2C of this person was 14,34,800, he should have paid the tax in this amount, but because of those exemptions under HRA 1,20,000, standard deduction 40,000, professional tax 2,400 and 50% of EPF, that is 43,200. So straight away his taxable income has come down to 12,09,200. And let's say if he doesn't do any kind of tax planning, and so how much tax he will be paying? So on a taxable income of 12,09,200 rupees, its taxable income will come to 1,82,270. So without doing anything, he has to pay a tax of 1,82,270. Now the fourth and the most important point, know all those tax saving options under different sections. So what are those different options? So if you see, there are many sections under which you can minimize your tax liability, but it does not mean that you have to utilize each and every section. I mean to say that do not invest just for tax saving. Sometimes it makes sense to pay the tax as well. Okay, so let's go through the individual section. Deduction under section ATC. Here the upper limit is 1,50,000, and there is a lot of competition in this particular section because you have a lot of choices to invest. Hence you need to be very careful which investment instrument you actually choose under this section. I will cover them in the next slide. Second one is deduction under section ATCCD. It only covers NPS, National Pension System, and you get tax exemption up to rupees 50,000. As I have mentioned earlier, do not invest in NPS just to save tax. First get it clarity on how NPS actually function. Today's session is not about NPS, so I will not cover NPS in details as of now. Then we come to deduction under section 80D. In this section you get tax benefit on health insurance premium up to rupees 25,000 if you take it for self, spouse and your own children, and also you get another tax benefit up to rupees 50,000 premium for your parents policy. Deduction under section 80G. Many times we give donation to different organizations, but you do not get tax exemption on all the donations. So in some donations you might not get any tax benefit, whereas in some other donations you might get tax benefit from 50% to 100%. Then deduction under section 80E. If you have taken education loan and you are paying EMI for the same, then you get the benefit of the entire interest amount. There is absolutely no limit. Then deduction under section 80TTA. Many of us, especially salaried person, do not show the interest income in their ITR just because of ignorance. I would suggest you going forward you should show your savings bank interest in your income, because you get tax benefit on interest of savings account up to rupees 10,000 rupees. And the last section is deduction under section 24. So if you are paying your home loan EMI, then whatever interest you are paying, you can claim tax exemption on interest up to rupees 2 lakh. Again I am repeating, to save on rupees 2 lakh should not be a criteria for taking a home loan. So as mentioned in my previous slide, there is a lot of competition under section ATC. So if you are a salaried person, then your EPF component by default comes under ATC. So if you see the calculations which I had done earlier, under section ATC by default 43,200 has already come over here, depending on the salary structure which I had shown you. And what all, so if you see, there is a host of other instrument. Okay, so now the thing is, which one should you go for? So I think you should concentrate. EPF is something you get by default if you are a salaried person, and the next two important thing which you should not ignore is life insurance policies and ELSS. So which brings me to the fifth point, that is you should take a term life insurance. Why? Because insurance premium paid for term life is eligible for tax deduction under section 80C. And the two most significant thing, it is the cheapest kind of insurance cover you can have for your family, and it gives a large amount of cover for your family with very less amount of premium. So if you are in the age group of, let's say age group of 30 to 35, and if you are a non-smoker, and if you take a term plan of 1 crore, then the premium will roughly be around 12,000 rupees. So Under section 80C, you should, the next important thing you should go for should be term plan. Okay, so we are still under section 80C. So 43,200 is consumed via EPF, and let's say 12,000, taking 12,000 as the premium for a term plan of 1 crore. So I take another 12,000. So you are left off with how much? 94,800, and this amount is something you should go for ELSS, that is equity linked savings scheme. So that's how you are taking the entire benefit of 1,50,000 under section 80C. Now, sixth point, take medical insurance for yourself and your parents, because you get tax benefit up to rupees 25,000 when you take it for yourself or for your self, spouse and your own children, and 50,000 if you take it for your parents. And also one more thing, if you do some health checkup, then there is additional tax benefit on amount up to 5,000 rupees. So for the time being, let me assume that you are paying a premium of 20,000 for the health insurance for covering you, your wife and your child. Now then 7 point, invest in ELSS for your 80C quota. So if you see these calculations, so I have taken approximately 43,000 from your EPF, 10,000 from your term life insurance, and the balance 95,000 I am taking it under ELSS. Now why ELSS? Because ELSS has the highest return potential. All the newspaper, magazines and financial advisors have been shouting from the rooftop that ELSS is one category of mutual fund scheme which is a very good option for tax saving, assuming you are willing to take the volatility of the market for a period of 5 to 10 years. But still many people do not take this option. You know the reason? The reason is like this. So there is this image, where a person by the name of Vishal, he went for the interview. So he was being asked, so Vishal, what do you know about mutual fund? And the answer what the Vishal gave: mutual fund investment are subject to market risk. Please read the offer document carefully before investing. Because we are bombarded with this message so many times, so somewhere it has been inherent in our mind that mutual fund means risk. But that is not the case. If your time horizon is 5 to 10 years, then you should definitely go for mutual funds. So this is the actual ELSS portfolio of one of my client. So what I am trying to show is this client has totally invested how much? 3,25,000, and what is the market value as on today? It's 3,01,000. So if you see, he is in a loss right? Now the reason why? The reason is very simple. Now this client has invested quite recently, sometime in the month of January 2018, April 2018, January 2018, April 2018. So if you could see, this portfolio is in loss. Now what I will do is I will show you another portfolio. Now this is the portfolio of one of my another client, wherein he had invested 7,25,000 in ELSS fund, and his today's market value is 16.69 lakhs. That is an annualized return of 16.6%. Now what is the reason for this? The reason is very simple. This client has been investing consistently in a disciplined way since 2008. See, he invested in 2008, 9, 10, 11, 12. So that's what I'm trying to say. So if you're coming for ELSS or any kind of mutual fund scheme, especially equity oriented funds, you should have a time horizon of 7, 8, 10 years kind of year. Okay.